So we're going to talk about 3 topics today. So the kind of the arrangement was let's figure out what are some of the things that are being most talked about in the last week or so. And then let's just give our own opinion, our frontline experience of what's happening related to that here in San Diego, California, on the front lines of mortgage itself, even if you're not in California or San Diego. So,
I mean, the biggest thing, but has been, Andy, interest rates finally dropped down to 6.77%.
Yep.
That is the lowest in nearly 2 months. And should people jump in now or wait?
So last week, Brian and I talked about this, should you get approved now, wait for rates to drop, or should you just wait until rates drop to get approved? And a lot of this really for us just came down to whether or not you're trying to move in a specific window of time, like 3 or 4 months or 6 months or later, or you can afford to wait. That's part of it. The other part of it is the afford part. Like I just mentioned, the afford to wait. Well, can you afford to afford it? Like, can you even afford at the rate where they're at now? And if you can't, or let's say you can't afford the price you want, we'll see what you can get approved for at this interest rate environment. And then as that rate goes down, then that purchase price can come up.
No, absolutely. I mean, the great conversation with Jerome Powell is that he finally showed some signs that indications that interest rates are going to drop. Not interest rates, I'm sorry, that he's going to reduce the Fed funds rate. So that actually just got a lot of investors. And that's the reason why we started seeing the interest or the mortgage bond securities going down, the 10-year treasury, which is, one of the indicators we understand that will allow interest rates to start going down. So that was good news. And a lot of investors, even though the rates haven't dropped, but when they see the Jerome Powell just talk about these things, it's like, all right, we're going in a positive direction. So I think it's time to, taper back and let's reduce these interest rates. And that's why we see, on average, that 6.77%.
And it's a little bit of a song and a dance, right? Because it's like they can't just tell you right now, hey, here's what we're going to do in 3 months. Here's what we're going to do in 6 months. Yeah. But at the same time, they can kind of leak some language that says, here's where we might be going. If we see this, we see that. Or when this happens, we'll consider this. And so there's some read between the lines stuff happening. Yeah. That's kind of why I said song and dance, because they're not going to really tell us. But here's what that tells me on my side of the deal when I hear you guys talking to people. It's sentiment. Yeah. It has to do with whether people feel positive about the direction of interest rates or they feel negative about it. Are they optimistic or pessimistic? And what it seems like compared to this time last year is I remember us talking about how everything was a quarter click to the right quarter-wise. It's like, wait, hold on. Winter became spring, spring became summer, summer didn't really happen, right? The summer buying season. And so I remember at this time last year, the sentiment was a lot different. This year, the sentiment has some cool marks to it, but it has more to do about the economy at large rather than just interest rates being the big elephant in the room. Yeah. With them coming down, not only the last couple of weeks, but also comparatively from 2024, I think this is what people who've been on the fence. I think this is what they've been waiting for.
No, most certainly. But at the same time, I feel like the majority of people are just consider the fact that this is a new norm, and they're always asking, is the Fed going to start reducing the Fed funds rate? That way, the Treasury starts reflecting the interest rate with that when that happens. But I just think a lot of consumer confidence just isn't there. The good thing is now we're seeing that that Jerome Powell just made again an indication that they're looking at maybe reducing the Fed funds rate. Now, my question to you is going to be: do you think the Fed's going to pull the trigger on this sometime next month? Or
so I think they might. The question that I was actually posing last week, or kind of hypothesizing, is: well, will it be 25 basis points or 50? Will it be 0.25% or 0.5%? And if something goes sideways and it has to be more than that, then that really is an indication of a couple things. Either their analysis has been totally wrong, or their strategy was wrong, or some really bad data happened that's letting them kind of come up with this decision as a response to that. I've been saying this for a long time. The Fed does not determine what things happen to a degree. I try to sit on the side of the fence of the Fed reacts to things, and then they kind of it's like when you turn the shower on too hot and you react to it. You go, oh, okay, I got to dial that back just a little bit. I feel like that's how they play it. So I think they will do a rate reduction. I think it's going to at least be a quarter. I think depending on how soft and how weak the data is, it could be a 0.5%.
Yeah. I mean, if it is, I just had to hear just a 0.25% difference. And on the 0.25% difference, if we're looking to purchase a $500,000 home with a 0.25% rate drop, that could lower your payment from about $150 to $230 a month.
Yeah. every month.
So we gotta take those things in consideration. For some people, let's just think about that. That could be a car payment.
Well, yes, and think about that over the course of time. That's tens of thousands of dollars. It's
Absolutely.
not like we can say to each other, "Hey, I saved $100 a month."
Yeah.
Okay, well, how long is that after 5 years?
Yeah.
It's way different than just like, oh, okay, it's $100. It's not.
Even just, let's just say, when rates drop again, probably most people are going to refinance. So let's just consider the fact this could be about a year's time or what have you. I mean, 200, that right there can help for daycare. That could help for groceries. That's somebody's car payment. There's a lot of, that's a lot of money where people could actually put in a different place to help them, or even just go one of those weekends that, we weren't thinking of going out anywhere, but now I have $200 some dollars. I can go out there and do something with it. I know it sounds minimal, but it can be a lot in other places.
Yeah, but you could tuck it away.
Exactly.
You could invest it somehow. You could pay off other debts you might have.
Absolutely.
You could be benevolent and do some giving in some form or fashion to local nonprofit or some agency in town that's doing something good you love. Like, there's a lot that can happen is the takeaway. And yeah, even 0.25% makes a big difference for people in the long run. You know, how many times do you send out financial financial, like the cost estimate to a client, and the 0.25% difference over the course of the loan is tens of thousands of dollars difference. Like, hey, here's why you should buy it down, or here's why it's worth doing this versus that. Because on paper, you look at the math of it, and you're like, it might only be $100 now, but it's like $30,000 over the first 10, 15, 20 years of the life of the loan.
Absolutely. The other biggest thing that I know that you and Brian were talking about was, being prepared and all that. There is a buyer psychology to this, to the readiness and the timing of things, and a lot of people, what we're seeing is, I want to be prepared so we do get them approved. And I think, prepared buyers are the best buyers. For sure. A lot of people are just saying, well, I'm waiting. And then, for instance, right now we currently have a transaction where the property went into probate, and it's here in Chula Vista, and they're selling it for $450,000, a 3-bedroom, 1-bath. And this is going to be near the Gaylord, where the lot square footage is a little over 7,500 square feet. It has a potential building ADU, what have you. So anyhow, they were referred to me, and this buyer is just like, I have this opportunity to buy this house for $450,000, right? It's going through probate. And I said, well, great. Connect me with the seller. Well, the seller, it just went through the trust. The seller happens to be the actual, the niece of the uncle who passed. So I said, hey, Wendy, great. I was introduced to you by Danny, and he mentioned that he's looking, to purchase his home, and you're going to give him a deal. The house is selling right now. Well, Zillow has it between $660,000 and $700,000. Right. And he's buying it for that little.
$450,000?
Exactly.
That's crazy.
Exactly. And she's willing, hey, we only owe $444,000 for the reverse mortgage, I'm sorry. And then we have to pay the realtor fee. So we may have to increase it to $500,000. And I said, well, after doing the numbers, you're more like at 460 something. Why don't we offer $500,000 and give him $20,000 towards closing costs? She's like, not a problem. And I said, well, how is it that you know Danny? Oh, we go to church together, and I love him and the wife, and I just want to give him a deal. Because it's a probate, we still have to put it on the market, but I'm willing to go with them.
Wow.
Well, fast forward, ran their credit today. Guess what? They're not ready.
Oh, no.
Not ready.
No. Are you
not
for
ready.
real?
Credit is not up to par. I'm not able to help them. Income's there. Savings isn't. And credit isn't.
Oh, man.
And this is part of that readiness, part of that, hey, I want to time it at a certain time, but it's too late now. This house will be foreclosed on in less than 2 months if they don't find a buyer now.
Oh, man, that's heartbreaking.
It's very heartbreaking because we're seeing this, the buyer psychology, of everything that's going on. You got to be ready. And again, the buyers that are most prepared are the ones that are going to win.
And the other part, I was writing this down as you were saying, because I've made this point before. I want to make sure I say it super clearly now, is that if you're a buyer and you are entering the market, you're going to be going up against someone who is ready. And so even if you feel like you're prepared and you might have all your I's dotted and your T's crossed, the other people bidding on a place or looking at the unit like you are, they might be more ready than you. Yeah. And I don't say that as a scare tactic or fear mongering. So get that off the table right away. I'm literally just saying that because if you are devoted to the process of being prepared, that you have everything checked off the list and you're 100% ready, then the market's going to be ready for you too. And then you'll be the person that everyone else has to contend with, because you're going to be the most prepared when it comes to submitting offers and looking good on paper for a seller to take your deal.
Yeah. I mean, it comes to the question I was going to ask you, Andy. Do you think too many buyers are waiting for the perfect rate and missing out on opportunities?
I don't know. I don't think so. And the reason is because you look at how many people are first-time home buyers last year in 2024 and this year so far, it's still in the 30%, like the mid 30%, which is historically consistent over time, even in different markets where prices were not where they are at now, interest rates were better than they are now, and the conditions were not the same. And so I think what has changed that we've talked about is behavior. I think the way people look at housing has completely changed. Yeah. When we're sitting here talking about, oh, I'll go buy that 50-year-old house that needs to work itself, but it has the yard that I want to put another unit on, or I want to do a garage conversion into a loft or whatever. That mentality is happening way more rampant now than it was even just 5 years ago, 10 years ago. Yeah. And that, I think, is changing. So that kind of being the motor is why I think there's still people buying houses now. And the hesitators that are going to continue hesitating, now that's who you're up against.
Yeah, no, exactly. And, you know, I do want to bring up in 2023 towards the end, we were seeing the rates in the high mid sevens, even close to the eights. And we actually had a lot of people purchasing that range. And then what happened in August, September of 2024, when we saw that dip, we started seeing, you know, conforming loan amounts, under like 5.25%. And then we saw the high balances at 5.6, 5.75. So we were able to drop people's rates from that high sevens down to that. That saved them substantially, $600-$700, you know, monthly on some people, because again, we're in California, we're in San Diego. Home prices are a little higher. Sorry, I was being too modest there. They're just way too high. Okay, it's what it is. They're just way too high. Yeah. So on a $1.2, $1.5 million property, in which we're helping a lot of our service members get into, that's about a $700-$800 monthly payment that they save, you know? And so we're going to see that again. Even though we've been seeing the mid sixes, mid sevens, I think we're going to get there with this information now that we're getting from from Jerome Powell. You know, I think we'll be seeing, at least, I'm saying, for our government interest rates, I think we'll be seeing, you know, the low fives, mid fives soon.
Yeah. And I'm going to say this next part. There's a nerd section, but hang with me here real quick. In the last 20 years, we've had two black swan-like events. 2008 and 9 was one of them, and 2020 was the other. Outside of those two things, the market is going to react, and rates will go up and down based on what the market conditions are, what the market data says, what jobs say, what global economics are doing, what the cost of oil, like all of these other factors without these black swan type events are really what are the barometer for the market. Yeah. And I think we're going to find this sweet spot historically that's between this like 5 and 6.5, where aside from those big events, I think that's where the market is going to be best suited long-term.
Yeah. So again, the best thing I can suggest with that information that you're giving is, you know, check your credit. If you haven't checked and you don't have the Experian app, download that thing. It's free. Go in there and check your credit, see where you're at. Review your equity. If you're going to look into refinance, right? Or you're looking to purchase, it still works the same way. You're not going to review the equity, but you'll review your credit, review your equity, and, you know, start working with your loan officer. You know, just start kind of gauging where you want to be if you're going to refinance, or if you want to put some money to work into an ADU or whatever it is that you want to do. But start preparing now.
That's solid. That's solid advice. And I guess I would say that in my own terms to be like, hey, window shop your own scenario. Like,
I like that.
Like war game it. Like go figure out, what would it take for me to do this? What would I have to do to make that? What would I have to earn to have this? And if you're trying to buy, and what would I have to do in my yard if I was going to build this, whatever. Like play that game a little bit. Get a piece of paper out, do some measurements, play some numbers, and figure out if there's something there for you or not. Yeah. And at least you've done the work to come to a conclusion rather than just hypothesize without any effort and come to a decision that might actually be may not be helping. helping you.
And Andy, I'm seeing a lot of my clients, they're going to Google, and I get Google is very helpful, but I'm telling you what Google doesn't have is that true life experience of an actual loan officer, seeing the true financials and be able to put you in the right direction. We are in the trenches. So find your loan officer, whoever you trust, and then just get to know them. See if they really are in the trenches. They can really give you the best advice possible to set you up and your family.
Yeah, good point.